Hey everybody, welcome to your weekend review for the week of Monday, November 7th, 2022. And oh, what a week it was. Bonds traded on both sides of unchanged overnight as yields as high as 4.188 topped out on the U.S. Treasury in the overnight and as low as 4.123 before ending the day actually at 4.2140. So got a lot of movement in the Treasury. This led to MBS being down 8 basis points on the open. After being steadily crushed to the most inverted levels in 20 years, the yield curve was ready for a bounce today, where the shorter maturities were outperforming the longer maturities. This pattern often coincides with MBS outperformance, and today was no exception. The short end got a push from several Fed speakers who mentioned that 50 basis point hikes would still be historically fast, and that traders could pivot their anxiety to focus on the eventual ceiling as opposed to how quickly we will get there. The upcoming week will be dominated by the CPI print on Thursday. The street is looking for a 0.7 month-over-month and come in at 8% on a year-over-year basis for the headline number, and 0.5% month-over-month and 6.6 on the core, which excludes food and energy. We will also get some Fed speak this week. Midterm elections are on Tuesday. However, I don't see that that'd be a big market mover depending on how everything plays out. Right now, the story is all about the Fed. Banks will be closed on Friday for the Veterans Day holiday, so everybody has to get everything done by Thursday. With essentially nothing on the economic calendar on Monday, the most notable headline for the bond market was the announcement of 13 new bond offerings, which should be why should we care about corporate bond offerings, but there are several reasons. At the simplest level, corporate bonds are competition and attention against the MBSs. Can also result in Treasury selling as a part of a hedging process. The impact on Monday's issuance glut is compounded by the looming Treasury auction cycle and the also looming CPI report this week. At the end of the day, we were down 21 basis points. Stocks were up 38 points on the day, and the U.S. Treasury came in at 4.214. Right now, the MBSs are right in the middle of a wide range with a ceiling at the 25-day moving average of 98.784 and a floor of 96.891, which is wide and generally leads to a lot of bounciness. With rising rates, the median mortgage payment has risen $558, or about 40% since the beginning of the year. The MBA's mortgage payment to rent ratio has been on a tear since rates have begun rising, though keep in mind that this tends to lag home prices by about 21 months. I'm sure the press will still pick up on it. Landlords reset their rent for an apartment upon renewal. However, the big chunks happen when the tenant moves and the apartment goes into market. So if home prices rise for a year, rent stays the same until the lease expires and so forth. We also got some interesting data from folks at the mortgage data technology company Ingenious. See what they did there? They witty over there. According to their research in 2021, there was a total of 353,000 loan officers, while 234,000 of them originated 3 or more loans. July 15th of this year, there were 276,000 licensed loan officers in the country. Of that total, just 188,000 had done 3 loans year to date, which is a low number. We're getting fairly close to the 2019 workforce levels, in which there was 263,000 total loan officers and 180,000 of which did 3 or more loans. That's kind of my point. 2019 wasn't that terrible, everybody. We can do this. And Tuesday, November 8th, started out fairly slow, but picked up as the day went on a little bit in the morning. While everyone was watching for the CPI number coming on Thursday, bond traders were worried about issuance. This is the old supply and demand argument. This refers to the regularly scheduled Treasury auction cycle, plus a variable slate of corporate bonds which have picked up recently. Corporate supply has ramped up at the start of the week, resulting in Treasury underperformance and MBS overperformance. There's also been some rumors regarding European bond issuances coming down the pipe, which adds a lot to the supply side of the equation. When we started the day, MBS were up 13 basis points and stocks were flat. By the end of the day, we ended up being up 47 basis points and stocks were on the positive side by 21 points. From a non-political viewpoint and solely based off of bond market and inflation, whether Republicans or Democrats have a majority of control, it makes passing spending bills much easier. Now remember, whether it's right or wrong, left or right, spending is inflationary. So that was some good insights from MBS Highway this morning. The October NFIB Small Business Optimism Index fell to 91.3 from 92.1. Owners were worried about future sales from a recession and don't want to hire because of that, and also inflation being their biggest concern.
A net 50% of companies reported raising prices. Retailers and wholesalers most widely reported raising prices. The frequency of reported price increases was highest among the retail trades at 69%, followed by 64% in retail. Other industry group averaged about 50% raising prices, with the exception of professional services, which were up 20%, probably just to cover their own cost of living. Vehicle sales index fell 2.2% month over month, and they are now down 10.6% year over year. Auto delinquency 60 plus days increased to 1.5% in Q3, which is low, but it is trending up. Bonds had one big push of buying momentum after the 9:30 a.m. NYSE open, potentially linked, like I said, to headlines regarding European bond issuance estimates. Momentum leveled off and drifted sideways at stronger levels for the remainder of the day. Like I said, ended up 47 basis points to the positive at 98.84, which brought us just above that 25-day moving average. So we'll have to see if that holds tomorrow. A lot of it will probably have to do with perceptions of election results. We also got a post from our sponsor at WellThatMakesSense.com. This is another post from the great book Persuasion, which is all about influencing people before you try to sell them things. According to this non-traditional channeled attention method, to get desired action, it's not necessary to alter a person's beliefs or attitudes or experiences. It's not necessary to alter anything except for what's prominent in their mind at the moment of decision, and a lot of times they don't even know what that is. So this is how you structure that moment before decision. So check it out at WellThatMakesSense.com. And then Wednesday turned into a busy day with lots of news. The overnight session was choppy and sideways, but in a narrow range. The 10-year yields were as low as 4.101, but had pulled back up to 4.12 by the start of the domestic session. The 820 CME Open saw another line of sellers, as was the case on Monday, or so it seemed at least this time. However, it was a large corporate bond offering from GE Healthcare was announced at 8:21 a.m. This was the actual market mover, one which quickly pushed yields several basis points higher. The sell-off in cryptocurrencies deepened as the day went on, sending Bitcoin to its biggest 4-day slump since June. Oil slid on sluggish demand from China. We also had a couple of Fed speakers expressing trepidation on hiking rates too much too fast. Seems like a coordinated effort for some to say A, some to say B, to kind of temper concerns with everybody and keep everybody mellow. U.S. consumers piled on another $25 billion in consumer debt in September, bringing the total to $4.7 trillion. Year-to-date, consumer credit is up $270 billion, the greatest 9-month surge in history. I've been saying for a while this coming recession is going to be for credit cards what the last one was for mortgages. There's also an element of the markets trying to decipher the political results and what it means. MBS were down 14 basis points early. Stocks were flat. The 10-year was down 3 basis points, like I said, starting the day at 4.155. Loan Depot reported earnings yesterday, narrowing its losses as it exits the wholesale business. The company also announced the launch of a digital HELOC program, which it hopes will drive earnings into 2023. Stamford, Connecticut-based luxury mortgage is pausing originations while it looks for a new partner. Starwood was in a deal to purchase the Connecticut lender. However, reports are that they backed out on that. Redfin has sunk to fresh lows as OpCo downgraded the stock and its business model to fundamentally flawed. They also announced today that they are closing their iBuyer business. Opendoor and Zillow are also announcing big layoffs, as well as Meta, the parent company to Facebook. Tomorrow brings our latest CPI figures, which should shed some additional light on the Fed's policy moves to date, how it's impacting things, and give an idea of what's going to happen in December. At the end of the day, we were down 22 basis points, landing the 5.5 at 98.63, which is pretty much right on that 25-day moving average. We were well above it for a while, dipped below it, and then pretty much landed right on it at the end of the day. The CPI number is going to make a big determination on how that plays out tomorrow. On some other information, from June 2021 to June 2022, the average residence move was 50 miles away from the previous residence, which is a huge increase. Over the preceding 5 years, it was pretty much flat at a median of 15 miles, which was the highest going back to 2005. So the average person moving 50 miles away is a huge increase. In some perspective having to do with the election, we got a great post today from econ70.com. When the president and the Senate are Republican and the House is Democratic, the S&P 500 averages a 13.7% return. When everything is reversed, which may happen in this midterm, returns average 13.6%. When the president is Democrat and the Capitol Republican, the S&P averages 13%. When DC is all Republican, equities average 12.9%. When it's all Democrats, it's 9.8%. With the Republican president and Democratic Capitol, returns average 4.9%. Some very interesting stuff there. Wow, what a day on Thursday. Oof, we saw some major gains. Haven't seen a day like this since, I think the day after the 2016 election. And even that day wasn't this crazy, except that day I kind of went in both directions. Huge 138 basis point gain early. Giant market reaction to the positive CPI report. Headline CPI came in at up 0.4 for the month on a 0.6 estimate. It was 0.4 previously. Year over year, it came in at 7.7% versus an 8% estimate, was 8.2 previously. Core, which is the Fed favorite, was up 0.3 versus a 0.5 estimate. 0.6 previously. Year over year came in at 6.3 versus 6.5 estimate. It was 6.6 previously. However, let's keep in perspective that this is supposed to be around 2. Shelter costs rose by 0.8%, which was the largest monthly increase ever. Rents rose 0.7%. Energy was up 1.8%, which is 17.6% year over year. Food prices were up 0.6%, which is up about 11% year over year. Improving by 0.3% was seen as a big win. It matches the lowest core reading this year. Market is seeing this as a sign that the Fed actions are taking shape, that they are actually working and maybe giving them ammo to stop hiking rates sooner than later. And even in a month when fuel costs went up. So that's kind of a good sign, though. Let's keep in mind, like I said, these are still high year over year in monthly numbers. Yesterday's 10-year auction went at the highest yield in recent memory, but it still was met with extremely weak demand. So today's whipsaw was especially pronounced. Initial jobless claims came in at 225,000, which is up 7,000 versus last week. Continuing claims rose 6,000 to 1.493. Continuing claims have been rising recently, so it could mean that people are having troubles finding new jobs, which is a weird thing because we kind of need that to happen to quell inflation, but it's a sucky thing to have happen. So we're in this weird world where bad news is good news sometimes. Cue a 30-year bond auction today, which happened. The high yield came in at 4.08, more than 3 basis points lower than the 1 p.m. expectation. Very strong result. Bid to cover was 2.42 compared to the average of 2.27. Direct and indirect bidding were both stronger than average, leaving dealers with far less than their normal share. At the end of the day, we were up 191 basis points on the MBS, which blew us through about 3 new ranges, put us right on that Fibonacci line at 100.534. Weird, it stopped right at that line. The 10-year had a crazy day. It was down 27 basis points on the yield. Let's look at that graph. So that brought us all the way down from that condensing range that we had going on all the way down to the 50-day moving average, pretty close. Have to see how reaction is. Gotta imagine there's gonna be some profit taking come Monday since the market is closed tomorrow. We also got a post from our sponsor at WellThatMakesSense.com. We are said to pay attention, which plainly implies that the process extracts a cost. So this is a good thing to keep in mind because persuasion is all about how you can get somebody's attention without them realizing it before you seek to actually influence them. So persuasion is all about that. So check out the post and get people to pay attention. Like I said, www.wellthatmakessense.com. Tomorrow is Veterans Day, so we're taking the day off to thank all of our veterans, which includes several members of my family. So thank you to everybody out there that is a veteran. Then we'll go into next week, where we're going to start off the week on Tuesday with producer prices. So this is going to be another read on inflation. So hopefully it follows suit with the CPI and is improving and reinforces that the Fed actions are working. If it goes the opposite direction, oh boy, it'll be interesting. Wednesday we get retail sales, which will also give an insight on if people are still spending money, which leads to inflation and a 20-year bond auction. And then on Thursday, we get the Philly Fed Business Index. So have a great long weekend, everybody. And if you get some time and you want to self-improve, check out our core influences and sponsors, WellThatMakesSense.com, as well as MBS Highway, MBS Live, Rob Chrisman, and all the ones listed here. And have a great and safe weekend.